Good morning, everyone. Sorry for the slight delay in our presentation. Please let me know whether you can hear me well. Please, could you please print something in chat box? Thank you. Thank you. I can see that's great. Great. So we can start in this case. Thank you for joining us today. We are starting a new series of our webinars on double taxation conventions. My name is Ina Gerasimova. I'm a tax and legal specialist here at Eltoma. Today's webinar provides an introduction to the important aspects of double tax treaties, commonly referred to as DTTs, based mainly on the OECD Model Convention and the UN Model Tax Convention. Today, we will focus on issues such as the purpose and definition of a double tax treaty, types of existing double tax treaties dealing with tax matters. We will briefly talk about the history of double tax treaties. We will talk about the relationship between double tax treaties and domestic law. We will discuss format and structure of a typical double tax treaty. We will briefly cover the tax covered and not covered by double tax treaties. And in the end, we're going to talk about the interpretation of double tax treaties. In the subsequent webinars, not today, we will talk about the substantive provisions of double tax treaties. So if you are interested, you can also join us in our following webinars. Okay, so let's begin. So what is the purpose of a double tax treaty? The main purpose of any double tax treaty is to eliminate double taxation of income arising in one territory and paid to the residents of another territory. So currently there is over 3,000 double tax treaty existing worldwide. The UK, for example, has more than 130 double tax treaties, which makes it one of the world's largest networks. That's the first slide. So what is double taxation? Double taxation is the levying of tax by two or more jurisdictions on the same declared income in the case of income taxes, asset in the case of capital taxes, or financial transaction in the case of sales taxes. The term double taxation can also refer to the double taxation of some income or activity. For example, in some jurisdictions, corporate profits are taxed twice, as you know, once when earned by the corporation and again when the profits are distributed to shareholders as a dividend or other distribution. The term double taxation is not usually used to refer to the taxation of the same income at the different levels of government, such as by federal, state, and local authorities. So how can double taxation be mitigated? Double liability can be mitigated in a number of ways. For example, the main taxing jurisdiction may exempt foreign source income from tax. Secondly, the main taxing jurisdiction may exempt foreign source income from tax if tax had been paid on the same income in another jurisdiction or above some benchmark to not include tax haven jurisdictions. And thirdly, the main taxing jurisdiction may tax the foreign source income, but give credit for foreign jurisdiction taxes paid. So in this case, it doesn't fully exempt taxes paid abroad, but it gives a deduction. Another approach is for jurisdictions affected to enter into a tax treaty which sets out rules to avoid double taxation. So in other words, to enter into a double tax treaty. So what is a double tax treaty? Double tax treaties represent an important aspect of international tax rules of many countries. Treaties are agreements between sovereign nations. Article 2 of the Vienna Convention on the Law of Treaties, which applies to all treaty, provides the definition of an international tax treaty. by stating that a treaty is an international agreement in one or more instruments, whatever called, concluded between states and governed by international law. Tax treaties are often called either agreements or conventions. As Article 2 of the Vienna Convention indicates, the name used is not important. Bilateral tax treaties confer rights and impose obligations on the two contracting states, but not on third parties such as taxpayers. However, tax treaties are obviously intended to benefit taxpayers of the contracting states. Whether treaties do so or not depends on the domestic law of each state. In some states, treaties are self-executing. So that is, once the treaty is concluded, it confers rights on the residents of the contracting state. In other states, some additional action is required. For example, provisions of the treaty must be enacted in a domestic law before benefits under a treaty can be given to the residents of the contracting states. This is the case for the UK, for example. Most importantly, under Article 26 of the Vienna Convention, treaties are binding on the contracting states and must be performed by them in good faith. This is the pacta sunt servanda principle. If a country does not respect its tax treaties, other countries may have no interest in entering into tax treaties with it. Most tax treaties are bilateral. There are very few multilateral tax treaties. For example, the Multilateral Convention on Mutual Administrative Assistance in Tax Matters, and some others. Although the possibility of a multilateral treaty has been promoted by scholars for many years, and is actually currently on the agenda of the OECD BEPS. In one of the following webinars, I will talk about the multilateral treaty, which has been adopted quite recently and signed in Paris in summer 2017, which introduces important amendments to the OECD Convention. So the reciprocity is the fundamental underlying principle of tax treaties, although its precise meaning is unclear. The provisions of almost all bilateral tax treaties are reciprocal. For example, if Article 10 of dividends provides for a maximum rate of source country withholding tax on dividend paid by a resident country to the shareholders resident in another contracting state, a maximum rate of tax and provisions will apply equally to both contracting states. For example, a 10% withholding tax. The reciprocal obligation applies to both states irrespective of the cross-border flows of dividends. In other words, Article 10 and the other distributive provisions of the treaty apply equally to both states, even when the treaty is between the developed and developing countries. Thus, significantly more dividends are paid by companies resident in the developing countries to the shareholders resident in the developed countries than vice versa. Similarly, the administrative provisions of tax treaties, such as exchange of information and assistance in the collection of taxes, are intended to apply reciprocally. So, the overwhelming majority of double tax treaties as of today are based in large part on either the United Nations Model Taxation Convention between developed and developing countries, also referred to as the UN Model Tax Convention, and the Organization for Economic Cooperation and Development Model Tax Convention, commonly referred to as the OECD Model Tax Convention. Both these conventions are available on the OECD's and United Nations websites. I indicated the links on the screen for your convenience. In addition, many countries have their own model treaties, which are often not published, but are provided to other countries for the purpose of negotiating tax treaties. The United Nations Model Tax Convention draws heavily on the OECD Model Tax Convention. Let's cover briefly the history of double tax treaties to understand where it all stems from. So model tax treaties have a long history, beginning with early diplomatic treaties of the 19th century. The limited objective of these treaties was to ensure that diplomats of one country working in another country would not be discriminated against. These diplomatic treaties were extended to cover income taxation once it became significant in the early part of the 20th century. After the First World War, the League of Nations commenced work on the development of modern tax conventions, including models dealing with income and capital tax issues. The work eventually culminated in model conventions in 1943 and 1946. These model conventions were not unanimously accepted, and the work on creating an acceptable model treaty was taken over by the OECD and a few years later the United Nations. Currently, the OECD has 35 members consisting of the major industrialized countries. The OECD Model Convention was first published in draft form in 1963. It was revised in 1977 and again in 1992, at which time it was converted to a loose-leaf format in order to facilitate more frequent revisions. Since then, revisions have been made every few years. The Committee on Fiscal Affairs, referred to as CFA, which consists of senior tax officials from the member countries, has a responsibility for the Model Convention as well as other aspects of international tax cooperation. CFA operates through several working parties and the Center of Tax Policy and Administration, which contains the Permanent Secretariat. The working parties consist of delegates from the member countries. So let's talk firstly about the OECD Model Convention. So the working party number 1 on tax conventions and related questions is responsible for the Model Convention, and it examines issues related to it on an ongoing basis. A detailed commentary organized on an article-by-article basis accompanies the OECD Model Convention. The OECD commentaries to the Model Convention are becoming increasingly important with respect to the interpretation and application of tax treaties, including some treaties between countries that are not members of the OECD. To take account of the positions of some non-member states, the OECD opened up the commentaries in 1997 to many of them, including Argentina, Brazil, China, India, Russia, and South Africa. The OECD Model Convention favors capital exporting countries over capital importing countries. Often, it eliminates or mitigates double taxation by requiring the source country to give up all or some of its tax on certain categories of income earned by residents of the other treaty country. This feature of the OECD Model Convention is appropriate when the flow of trade and investment between the two countries is reasonably equal. And in this case, the residence country's taxes, any income is exempted from the source country. However, the OECD Model Convention may not be appropriate for the treaties entered into by net capital importing countries. As a result, developing countries have devised their own tax treaty under the auspices of the United Nations. So the work of the United Nations on a model treaty commenced in 1968 with the establishment by the United Nations Economic and Social Council, commonly known as ECOSOC, of the United Nations ad hoc group of experts on tax treaties between developed and developing countries. So one of the major differences between the United Nations Model Tax Treaty and the OECD Model Tax Treaty is that the United Nations Model Treaty is entered into between mainly developed and developing countries, when the flow of trade and investment between the two countries is not equal. So the group of experts produced a manual for negotiation of bilateral tax treaties between developed and developing countries, which led to the publication of the United Nations Model Tax Convention between developed and developing countries in 1980. The Model Convention was revised in 2001 and again in 2011. In 2004, the group of experts became the Committee of Experts on International Cooperation in Tax Matters. The committee maintains detailed commentaries to the United Nations Model Convention. It is also responsible for the publication of several useful manuals on tax issues important for developing countries, such as on transfer pricing and administration of tax treaties. The members of the committee are tax officials nominated by their governments and appointed by the Secretary General of the United Nations, who serve in their individual capacity. A small majority of the members of the committee are from developing countries and countries with economies in transition. The United Nations Model Convention follows the pattern set by the OECD Model Convention, and many of its provisions are identical, or nearly so, to those in the OECD Model Convention. Therefore, it makes no sense to review the United Nations Convention as an entirely separate one, but rather making an important but limited modification to the OECD Model Convention. So what is the major difference between the two model conventions, the OECD Model Tax Convention and the United Nations Model Convention? So the main difference between the two model conventions is that the United Nations Model Convention imposes fewer restrictions on the taxing rights of the source country than the OECD Model Convention. Source countries, therefore, have greater taxing rights under it compared to the OECD Model Convention. Let's consider a few examples. Example number 1. Article 12 of the OECD Model Convention on royalties prevents source country from imposing tax on royalties paid by a resident of the source country to a resident of the other country. The United Nations Convention, in comparison, does not have such a restriction. Let's consider the second example. The United Nations Model Convention gives source country increased taxing rights over business income or non-residents compared to the OECD Model Convention. And the third example, how the permanent establishment is defined under the OECD Model Convention and the United Nations Model Convention. So, for example, the time threshold for a construction site permanent establishment under the United Nations Model Convention constitutes only 6 months, and under the OECD Model Convention, it constitutes 12 months. Furnishing services under the United Nations Model Convention constitutes a permanent establishment if services are rendered for 183 days or more in the jurisdiction, and under the OECD Model Tax Convention, and permanent establishment is deemed to be created only if services are provided through a fixed place of business, normally for more than 6 months. So that's the major difference between the two conventions. So what is the relationship between the double tax conventions and domestic law? The relationship between them is a pretty complex one in many countries. The basic principle is that the treaty should prevail in the event of conflict between the provisions of domestic law and the treaty. In some countries, such as France and Russia, the principle has a constitutional status. In many countries, government has the authority under domestic law to override the provisions of a tax treaty. For example, legislative supremacy is a fundamental rule of law in many parliamentary democracies. As a result, it is clear in these countries that the domestic tax legislation can override their tax treaties, such as the example can be the UK again. However, the courts in these countries may require that the legislature explicitly indicates its intention to override a treaty before giving effect to a conflicting domestic law. Courts may also strain to find some ground for reconciling an apparent conflict between a treaty and domestic legislation. In general, tax treaties apply to all income and capital taxes imposed by the contracting states, including taxes imposed by provincial, local, and other subnational governments. In other federal states, such as the United States or Canada, the treaties apply to all income and capital taxes imposed by the contracting states, including taxes imposed by provincial, local, and other subnational governments. However, in some federal states, the central government is constrained by constitutional mandate or established tradition from entering into tax treaties that limit the taxing powers of their subnational governments. Accordingly, the tax treaties of such federal states apply only to national taxes. So, in such circumstances, a subnational government may impose taxes in a manner that would not be permitted for its central government. So, which procedures are required to introduce tax treaties into domestic law? If we are talking about the cases where tax treaties are not self-executory. So, in general, such procedures may be divided into three broad categories. Firstly, those where a treaty automatically becomes part of domestic law when it comes into effect. This is the case for Belgium and Netherlands. So in these cases, ratification by the head of state, only the ratification by the head of state is required. So the state affirms the intention to be bound by the rules established in the Double Tax Convention. External effects are produced by virtue of the exchange of the instrument of ratification. This act determines the moment when the parties express their final consent to the Double Tax Convention, and subsequent publication in the official gazette ensures in most cases legal efficacy. Secondly, there are also countries where approval, usually parliamentary, is required before a treaty becomes part of domestic law. This is the case for Germany and Italy. And thirdly, there are countries where a specific internal legislation is necessary to transform the treaty into domestic law, which is the case for the UK and Denmark. The completion of the normal legislative procedures are required in these cases. Another important thing to note is that tax treaties do not impose tax. Tax is only imposed by domestic law. Therefore, tax treaties limit the taxes otherwise imposed by a state. In effect, tax treaties are primarily relieving in nature. Similarly, tax treaties do not allocate taxing rights, although it is often claimed that they do. In light of this fundamental principle, it is usually appropriate before applying the provisions of the tax treaty to determine whether the amount in question is subject to domestic law. And if the amount is not subject to tax under domestic law, it is unnecessary to consider the treaty. Sorry, I will just give you a brief example. Under the provisions of a treaty between, let's say, country A and country B, let's assume that the interest is paid by a resident of one state to resident of another state and is subject to a maximum rate of withholding tax of 15%. If under the law of country A, interest paid by a corporation resident in state A to an arm's length resident in another state in country B is exempt from tax in country A, the treaty does not give the right to country a right to impose a 15% withholding tax on the interest. So again, if the domestic law doesn't provide any tax, the The fact that a certain amount of tax is provided by the double tax treaty does not impose the obligation on a taxpayer to pay the withholding tax. So let's move on to consider the structure and major provisions of a typical bilateral tax treaty, which is based either on the United Nations and the OECD Model Tax Convention. So the Chapter 1 covers the scope of the convention, the persons covered in Article 1 and the taxes covered in Article 2. We will talk about the taxes covered by the typical bilateral tax treaty a bit later. Chapter 2 provides definitions. Article 3 provides general definitions. Article 4, provides the definition of a resident. And Article 5 provides a definition of a permanent establishment. Chapter 3 contains distributive rules of the treaties, which provide how the income should be taxed. So Article 6 covers income from a movable property. Article 7 covers business profits. Article 8 covers shipping, inland waters transport, and air transport. Article 9 covers associated enterprises. Article 10 from Article 10 to Article 12 cover dividends, interest, and royalties, so withholding taxes on passive income paid. Article 13 covers capital gains. Article 14 regulates income derived from professional and independent services. Article 15 contains income from taxation provisions with regards to the income from employment. Article 16 covers taxation of directors' fees. Article 17 covers entertainers and sports persons taxation. Article 18 covers pension. Article 19 covers government service. Then finally, Article 20 covers the taxation of students. And finally, Article 21 covers the taxation of other income. Finally, the Chapter 4 covers the taxation of capital. Chapter 5 covers different methods for elimination of double taxation. So Article 23A covers exemption method, and Article 23B covers credit method. In general, if the contracting states in which income arises is entitled by the rules of the Article 6 to 21 to tax the income, the contracting state in which the taxpayer is resident is obligated to provide relief from double taxation. Under the exemption method, the residence country excludes or exempts the income from the residence country tax. Under the credit method, the residence countries provides a deduction in the amount of taxes paid abroad. Chapter 6 covers special provisions of the bilateral tax treaty. So it provides the non-discrimination provisions, the mutual agreement procedure when there are some disputes between contracting states. Article 26 provides for the automatic exchange of tax information. Article 27 provides the possibility of assistance in the collection of taxes between contracting states. Article 29 covers the taxation of members of diplomatic missions and consular posts. And finally, Article 29 covers the territorial extension. Chapter 8 contains the final provisions with regards to the bilateral tax treaties. So what taxes are covered by a typical bilateral tax treaty? In general, it is the income tax, corporation tax, capital gains tax, pay as you earn tax, in case the relevant jurisdiction has such tax, for example, the UK. Also, the withholding tax arises in the source country, wealth taxes, Often it also provides provisions with regards to the national insurance. Sometimes it contains provisions with regard to some state taxes. Also, the provisions with regard to PRT, for example, in the cases with UK and Nigeria and UK Finland, and also development land tax, for example, between the UK and Norway or the UK and Sweden. The taxes that are not covered by typical bilateral tax treaties are normally the indirect taxes, such as VAT, inheritance tax, stamp duty, land tax, capital duties, and underlying tax. Okay, and finally, we're going to talk about the interpretation of double tax convention. Double tax conventions, how they should be interpreted. The Vienna Convention on the Law of Treaties is a United Nations treaty which, although adopted in 1969, entered into force only in 1980. Articles 31 to 33 of the Vienna Convention are particularly relevant. Most countries, with a notable exception of the United States, have signed the Vienna Convention. There is also an extensive commentary to the OECD Model Treaty, which is also an invaluable source of background and information when dealing with treaty issues. Not only does the commentary explain the various provisions, but it also lists reservations and observations in respect of each article. A reservation indicates that a particular country does not intend to adopt the particular provision in its tax treaties. Observations usually indicate that a particular country's interpretation of a provision differs from that of the majority of the OECD members. These mechanisms, such as reservations and observations, are required because the model treaty may only be amended with the unanimous consent of all OECD members. The commentary has become increasingly important with respect to the interpretation and application of tax treaties, including some treaties between countries that are not members of the OECD. As I have already mentioned, to take account of the provisions of the position, of non-member states, the OECD opened up the commentary in 1997 to major non-member countries, as some were at the time, including Argentina, Brazil, China, Israel, Russia, and South Africa. Current observers at the OECD Committees on Fiscal Affairs are Argentina, China, India, Russia, and South Africa. The treaty itself also provides general definitions in paragraph 1 of Article 3, and also further definitions in the articles which deal with particular topics. For example, the dividend, interest, and royalties articles, which each of them contain a definition paragraph. Where the treaty does not define a term, a definition in the domestic laws of the contracting states may be used. This is provided in the Article 3, subsection 2 of a typical double tax treaty, either based on the OECD model or the United Nations model. The paragraph refers to the application of the convention by contracting states, which is the state applying the treaty, so the source state. Over and above the legislation, there is also case law. A country is not confined to its own case law, as many terms are a creature of international law. For example, the concept of a permanent establishment. There can be a strong claim to a uniform international meaning, and so decisions in other jurisdictions are of real value and can be also applied. So we have come to the end of our webinar today. In the subsequent webinars, we're going to cover the substantive provisions of the OECD Model Tax Treaty and also the recent amendments to the OECD and United Nations, mainly to the OECD Model Tax Treaty. So if you are interested, please do join us. We will send you the relevant invitation. And at the end of this webinar, please let me tell you briefly about the services provided by Eltoma Corporate Services. Eltoma Corporate Services provides a wide variety of services, starting from company incorporation and maintenance, to legal services, tax planning, IT and web services, immigration services, obtaining licenses and permits, and other services that you can see on the slide. Eltoma Corporate Services also provides recruitment services. You can find out more about these services by going to our website. The aim is to deliver custom recruitment services to support employers within the Cyprus market to select the best person in the correct position. Also, we have the Cyprus real estate project. So people who would like to reside, to relocate to Cyprus, or for example, buy a property in Cyprus, can also go to our website and check the available properties. Finally, you can contact us by calling or emailing us. We have our main offices are located in Cyprus and Singapore. Also, we have offices in Russia, Ukraine, the United Kingdom, and Hong Kong. And you can also send us an inquiry by emailing us on info@eltoma.com. Thank you once again for your attention, and please do join us for the following webinars on double tax conventions, which will cover the substantive provisions. Thank you once again, and have a lovely day. Have a good week. Bye.